Target date funds are certainly prevalent in 401k plans. Vanguard recently released a study of their record-kept plans, and more than 84% of plans on their record-keeping platform were offering target date funds. So if you're a plan sponsor who is not offering target date funds, I think it's important to ask the question, why? And that's particularly relevant in the context of default investments. So most plan sponsors are certainly taking advantage of QDIA, which is Qualified Default Investment Alternative status for default investments, and that offers fiduciaries and plan sponsors some protection from liability as it relates to the default investment. So target date funds are particularly relevant in that context because they serve as a very good QDIA option and a very good default fund. If you're not using target date funds, I think one could raise the question, how is it appropriate that everyone, regardless of their age, risk tolerance, etc., be defaulted into the same investment? Because that's what's happening if target date funds are not used as the default. Plans offering target date funds are experiencing a wide disparity in the adoption of target date funds. So some plans are seeing very high adoption rates and assets flow rapidly to target date investments, whereas others are seeing really fairly low utilization amongst participants. And often what drives that are issues such as turnover and then education and advice efforts. So if you're a plan sponsor that's offering target date funds, that's great, you've taken a good first step. But if you're seeing very low adoption of target date funds, we would think that's problematic and we want to address it. The target date funds solve the issue of many plan participants allocating poorly upon their entrance into the plan. So if you've got low turnover and people really chose poor allocations to begin with, offering target date funds isn't going to solve that problem. Instead, we want to make considerable efforts on the advice and education front to drive participants towards target date funds. And if that's not successful, it's time for plan sponsors to consider going a step further and considering something called re-enrollment. Re-enrollment will likely be an effective method to get participants to improve their asset allocation by migrating to target date funds, largely because participants are inert, so they're not particularly interested in changing their asset allocation, largely because they don't know how, but there are other factors at play as well. So a re-enrollment will take the plan and allow people to make new investment elections. In other words, re-enroll into the plan. However, if they don't do that, and a lot won't, depending on your demographics, they will automatically be defaulted into a target date fund. So the re-enrollment process is likely to move a significant amount of assets and a significant number of participants to target date funds, and they'll be their sole investment, which means that they'll be properly allocated in an age-appropriate fashion, and they'll grow more conservative over time, which are the things that really every investor, particularly a retirement investor, should be doing. If you're a plan sponsor that's offering target date funds, we are supportive of that effort. We think that's a good thing, but we want to call attention to the fact that the Department of Labor recently issued some guidance on target date funds, and while they were largely supportive of target date funds, they did raise some issues. So a target date fund is much like the other investment options in your 401k plan. There should be diligence exercised in its selection and monitoring. So it's important for plan sponsors to have a process around the selection of the target date funds, just as they would the selection of the other investments. Of particular note in the guidance was the Department of Labor's concern with proprietary offerings. So in other words, if you're offering a brand of target date funds that is the same brand as your record-keeping platform, it might be difficult to justify, without significant documentation and a process anyway, the selection of those investments, and they could be called into question. So, as always, we want to make sure that you're exercising diligence around the process for the selection of those funds. Make sure you're evaluating outside or non-proprietary offerings in addition to those offered by your record keeper.